Welcome to the Market Huddle Plus, episode 32. I'm Patrick Serezna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome back our good friend Aidan Garrib, who is head of global macro strategy at PGM Global. Aidan, great to have you back on the show.
Thanks, Patrick. Good to be here.
All right, listen, you send me two great reports. I want to go through them both, but I just wanted to step back and really first just talk to you about these markets. The S&P 500 has been on a epic 5-6 month run, well over 1,000 S&P points, like 25% that it's been running, and it's been relentlessly rising. How do you size up what's happening here in the markets, and how do you think it plays out?
Sure. Yeah. Look, I'm a big believer, as we'll get into when we turn to the Fed discussion, as liquidity as a driver for risk asset prices. And when I look at what's going on the Fed's balance sheet, liquidity has been increasing for some time. In fact, you wouldn't even know that the Fed's been doing quantitative tightening, given the increase that we've been seeing in liquidity conditions. And those liquidity conditions, they will percolate into markets, as I'm sure we'll discuss. So for me, I'm not that surprised that you're seeing just this all dips being bought, is to quote Patrick, to quote you there, as you often say.
Yeah.
And I think that just continues until some of these risks to liquidity present themselves, which could happen in the next few months. And I'm sure we'll get into that discussion.
Perfect. All right. Well, I want to just touch on the one report and just on a high level basis, and then I want to talk about that Fed report that you had. So you sent me a report about the risky gambit of attacking Russian refineries, and so Ukraine drone attacks have been reducing Russian oil capacity significantly. I will maybe significantly. We'll ask you in a second. But how do you see these actions influencing the broader geopolitical landscape, especially in relation to energy security and other international relations?
Sure. So I guess what I would say is overall, what we've been seeing is it seems like the US has been trying to advocate for India to get cheaper oil prices from Russia. One way that could happen, and so Amos Hockenstein, which is a senior U.S. official, he basically said, I quote in a Reuters news article from March 12th, "I'm trying to get the Indians to negotiate better prices by forcing the tankers, so the oil tankers, into a different direction. I think the Indians understand what we're trying to do." And so basically what's happened is the Ukrainians have taken out somewhere between 9 and 13% of Russian refining capacity. And that first slide I'm showing there, that you're showing right now, highlights just this. So these are the drone attacks. That's just a map from Reuters. What's actually interesting about Russian oil production as opposed to Saudi or U.S. production is Russia doesn't have much storage capacity, and they can't, due to some technical issues, lack of investment, but also the geology. Russia can't shut in oil production. And so if you just go to the next slide very quickly, just lower down on that page, page one, you'll see Russian oil output. It basically collapsed when the wall came down in the late 80s, I should say, and it took like 2 decades, 3 decades to get back to those 1990 levels. The big problem that Russia has is that the rock formations where their oil is, it's very porous. So if you want to shut in an oil well, you basically have to pour like black sludge into that oil formation, and then if you have a porous rock underneath, then the porous rock gets basically all gunked up with the sealant, and then so if you then want to reopen the well, it becomes very difficult to do because everything's all gunked up. You don't get the pressure, you can't get the oil out. So it looks like what the US is trying to force here is for Russian refining capacity to come out of the market, but for Russia to just keep pumping oil because they can't shut it in. So essentially, they want Russia to flood the market with oil. What that would do, and then again, I'll go back to that Amos Hockenstein quote where he says he wants to force the tankers to go in a different direction. Well, if you scroll down to the next slide here, Russia's Ural crude price is about $75. In order for the tankers to be insured, they need that oil price to be below $60. That's that, Western government oil price cap that they've put on Russian crude. If you want to ship that crude and get insurance on that crude shipment, that crude needs to be trading at $60. So the hope is that they will force Russia, because they can't refine it and they can't shut it in, to just export it and export it hard. And what that will do is drive down the price of Russian crude, flooding the market, lowering inflation for Joe Biden's reelection, bringing the Indians on side, getting China to buy into some U.S. policies as well. Um, and so it's uncertain if this is going to work or not. So I'm looking for opportunities that you can really, benefit from this. And the opportunity that seems to come up is really, well, there's two. One is the oil tankers, and you can see that it's lower down on page 5. And so I'm just showing on page 5 some of those tanker stocks. Yeah, just a little bit above. I think the chart directly above that one, Patrick, you can see the tanker stocks. Like, they've ripped. And if you force more oil onto the market and the tankers have to carry that oil, well, the tanker rates are going to go up. So the tankers should do well. But the other big beneficiary in all of this, uh, maybe the oil refineries and the oil refiners in the US. And there's an ETF called CRAK, KRAK, which is kind of a play on the crack spread, which is the refiner profits. And so just what I do in the chart or the table on page 6 is I just show a few of the fundamental metrics for some of these oil refiners. And so basically, I think what the play is if oil prices decline, then these refiners get oil at a cheaper price, right? But then also, because Russian oil refineries have been taken out by the drone attacks, well, less refining capacity means there's less refined product that comes through. So you get higher prices for gasoline, for diesel, for jet fuel, for kerosene, etc. And then what that means is the profit margins for these refiners improves because your input costs, i.e., the crude oil, declines in price because you're getting the cheap Russian crude. But the refinery attacks and the dearth of refining capacity drive up the price for refined product, which is their output. And so they should do well in this environment.
Well, that's a great conclusion. And so the thing is that they've already had a pretty good run on many cases. You still think that there's room for these refiners to just keep going because many of them are already up considerable amount in the last couple months.
Sure. So that's a great question. If you scroll down to page 6, the first chart, the top table there, you can see some of the metrics. So look, I'm not, I don't do, bottom up stock research, and I don't, can't really discuss the names. But if you look across the board, PE ratios sub 10, so they're still relatively cheap on a trailing basis. On a current year basis, they're a little bit more expensive. But the reason for that is just sales growth, as you're seeing here, has slowed off the crazy levels of late 22, early 23. So there's just some base effect issues going on there. But then when you look at return on equity, when you look at free cash flow yields, when you look at dividend yields, they're still, fairly attractive in terms of ROE and free cash flows. And so you're right, the price has been bid up, the dividend yield has come down a bit here. Um, but if this margin story plays out, then you're going to see these multiples really start to expand from pretty cheap levels here. ROE should pick up, and free cash flow yield should pick up as well.
Perfect. Well, let's move on to your second report because there's some really good, juicy stuff in here. And so let's dive into navigating the Fed's impact on the global markets. Now, on page 2, you have the report highlights that the asymmetric impacts of quantitative easing or quantitative tightening on the markets. Could you explain the impact in layman's terms and how they have historically affected the banking sector's operations or the broader economy?
Sure, yeah. So I'll start with this, and then I might skip some charts as we drift through. What this chart shows you is the relationship between bank reserves. This is what's created by the Fed when they're doing quantitative easing. And I'll spend a little bit more of this on the next slide. But for this slide, all you really have to know is when bank reserves are going up, that's equivalent to quantitative easing. And as that increases, what I'm showing on the right-hand axis, and it's inverted, are high yield and investment grade spreads. So on the right-hand axis, the higher up those light blue and red lines go, it means spreads are being compressed, i.e. prices for high yield and prices for investment grade bonds are doing well. The way QE works is it makes banks flush with bank reserves, which then incentivizes banks to expand short term carry trades, namely FX swaps, interest rate swaps, and repo. And the mechanism by this works, there's a few, but one of the important ones is when central banks do quantitative easing, it improves banks' capital and liquidity ratio, specifically the net stable funding ratio. So it makes banks' funding seem more stable, more kind of like a creative. It basically decreases the cost of banks to use their balance sheet and incentivizes them to take more risk. And we can really get into some nitty gritty of the details on the net stable funding ratio, but essentially all we need to know is that when there's QE, it drives down the cost of banks' balance sheets and thus allows them to earn more money on their balance sheets. And they'll do that using FX swaps, interest rate swaps, and repo. So what's important here is on page 3, I'm showing the liability side of the Fed's balance sheet. A lot of attention is usually placed on the asset side. How many bonds is the Fed buying? What's the size of the Fed balance sheet? But really, it's the liability side that matters because these liability components, and there's 4 big ones, these either improve liquidity conditions in the financial market or withdraw liquidity from the financial market. And so I'll just give a pretty brief rundown here. Uh, the reverse repo facility, that's a fairly new facility. It was started in 2021. The Fed was worried rates would go to zero and money market funds would essentially chase T-bill yields all the way to zero. So the Fed said, hey, money market funds, instead of chasing T-bill yields all the way to zero, just give the money to us and we'll pay you interest on that. So as the reverse repo facility increases, that takes liquidity out of the financial system and sterilizes it on the Fed's balance sheet. If we work our way up, the light blue is currency in circulation. That's pretty straightforward. If currency in circulation is increasing, liquidity is increasing. Bank reserves. So this is the Fed liability created by quantitative easing. So when bank reserves are increasing, liquidity is increasing. And then you have the TGA, which you can think of as the Treasury General account. It's the government's checking account with the Fed. When this increases, it means usually the government is selling treasuries and then taking cash and kind of putting it in their bank account. So as this liability component increases, it draws down liquidity from the financial system. So 2 of these increase liquidity, i.e. bank reserves and currency, and 2 of these subtract liquidity, reverse repo and TGA. And so if you move on to the next slide, page 4, here I show total bank reserves in the system. And what's important to note here is since the beginning of 2023, you would have no idea that the Fed was still doing quantitative tightening because more like all of the QT that the Fed's been doing and then some has been offset by improved liquidity conditions in the financial markets, right? And so there's really been a couple of drivers of this, but for the people watching and for the listeners, the upshot or the main conclusion is if liquidity is increasing, it's no surprise you're seeing outperformance of long duration assets, whether it's the NASDAQ or unprofitable tech or dog coins going to the moon, right? All those things are going to happen if you have liquidity becoming more ample in the system because carry trades will carry the day, not to have a little bit of a pun there. So on page 5, I'll talk about one of the dynamics that are I think, like pretty well understood. I'll still go into a little bit detail here. And then I'll explain something that's maybe less well understood and where maybe some risks lie for the outlook for liquidity and momentum and carry trades. Um, so this chart shows you the reverse repo facility. So reserves, the bank reserves minus the reverse repo facility. And then on the right hand inverted is the repo facility. So the main takeaway here is almost all of the increase that we've seen in bank reserves has come from the reverse repo facility. And what that means in practice is that the money market funds are taking cash that has been sterilized in the reverse repo facility out. They're buying T-bills with this. And then as the government spends those T-bill proceeds on, aid to Russia or aid to Ukraine and Israel and missiles and, whatever else the US government spends money on, that ends up injecting liquidity into the system. So essentially, money's coming out of a sterilized account on the Fed. That sterilized money is moving from the reverse repo facility to the TGA and then filtering in through bank deposits as that money gets spent. So we'll skip to page 7 here. Janet Yellen. So Janet Yellen, she is the Treasury Secretary, but she was the Fed governor, so she knows how the plumbing works. Usually, the Treasury will issue about 80% of issuance is coupons and about 15 to 20% is T-bills. But that's been flipped on its head over the last year or so, where almost all of the issuance has been T-bills. And so this was a very smart plan by the Treasury Department because what it enabled the government to do is finance its deficit from the reverse repo facility and not draw down liquidity that would be in the financial system, right? So it's just taken sterilized liquidity from the
Right.
reverse repo facility, put that in the TGA as the bills have been bought, and then that gets spent down. Now, that the ability of the Fed to do this is quite limited because if you were to go back to page 3 very briefly, the reverse repo facility has been drawn down quite sharply, right? So on page 3, you'll see the reverse repo facility. It's back to just $480 billion. And 480 billion sounds like a lot of money to me and you, right? Well, maybe not to you, Patrick,
Yeah.
because you have a
Oh,
successful
oh yeah, yeah,
podcast,
yeah.
but for the rest of us, 480 billion seems like a lot of money. But the treasury issuance every month, or sorry, every quarter is $760 billion. So, like the 480 billion doesn't go very far when you're issuing 760 billion every single quarter. The slides on page 8 or 9, they're more just informative. On page 8, I really just show the large nature of the fiscal deficit. So on a primary basis, so this is just cash inlays versus outlays, the deficit is 4%. And then when you factor in interest payments, it's negative 8%. So this just reinforces the view that that fiscal deficit that needs to be financed every quarter is not going away anytime soon. And then on page 9, I take a table directly from the Congressional Budget Office where you can see the 3 lines at the bottom are the year over year changes projected for mandatory spending, discretionary, and then net interest. So you can see mandatory spending is growing at 5% for the foreseeable future, discretionary, call it 3%, and then net interest in the
Yeah.
8 to 10% range. So again, the deficit's not going anywhere. It needs to be financed. And the ability to finance that from the reverse repo facility is we're really coming to a close in that because there's just $480 billion left in there.
So Aidan, I'd love you to then explain that in a little more detail by explaining simplifying the money markets. You have this amazing chart here on page 11. Talk us through the scenario of what we're seeing here.
Okay, so to really understand this chart, it helps if you maybe go back to page 10, just very briefly. So in addition to the reverse repo facility where the money market funds are prevalent, There's also the primary dealers, and they've been buying all the duration. So money market funds have been buying T-bills at the front end of the curve, and then the duration that's been issued, as I'll show on another slide that makes it more clear, that's been bought by the primary dealers. And now the primary dealers, they're this very integral, they play a very integral role in the financial system. They work with the Fed on treasury issuance. So the treasury would run a massive deficit and tell the Fed, okay, we need to issue 760 billion of bonds this quarter. And the treasury and the Fed would say, okay, we'll sell those bonds. The primary dealers, they're a collection of 24 banks and securities firms. Their job is to buy those treasuries from the Fed and then sell those on to, retail investors or pension plans or other people, right? Because if I want to buy a treasury, I don't face the Fed, right? I'm too small to
Yeah.
face the Fed. So the primary dealers are an intermediary. And so on page 11, I just briefly explained the way that the primary dealer system works. So what I lack in, call it artistic merit with this flow chart, I hopefully make up for in simplicity. So really what I show is in an ideal world, the Treasury runs a deficit, the Fed issues those bonds, the primary dealers will buy the bonds, and then they'll sell them to banks or pension plans or retail investors or retirees, and then collect the money and send it back to the Federal Reserve by 3 p.m. the following day. Now, what happens if there's not much demand for duration, right? Or we need to make sure that duration isn't drawing down bank reserves. Well, what will happen is the deficit's not going away, so the treasury still needs to issue. The Fed will issue those on behalf of the treasury. The primary dealers, well, they still kind of need to buy those bonds from the Fed. And so what they will do is then do repo. So they will say, hey, I really need to pay the Fed. I can't sell these bonds. Why don't you lend me money overnight or for 3 days or for 7 days or 3 months? And and that will allow me to pay the Fed, and then I'll pay you back. I'll find a way of paying you back, at the end of that repo contract. So all repo is just an agreement where the primary dealers will, pledge the collateral like the treasuries, take the cash, and then pay the Fed. And so what I'm showing on page 12 is the last time the Fed was doing quantitative tightening and the primary dealers were buying all the treasuries, we saw the Fed's balance sheet decline. So that blue line declined from 2018 to 2019. And then inverted on the right is the repo index. And you saw repo rates were basically increasing because the primary dealers are putting upward pressure on repo rates, right? They're basically saying, hey, I need to borrow. Hey, I need to borrow to pay the Fed. So if you have cash, you're like, okay, I'll lend it to you. But the more you need to borrow, the higher the rate would be. And so we got the repo market blow up in 2019. And then the Fed had to come and start, easing the balance sheet again. So why this becomes important for markets, right? Like why equity investors, risk asset investors should really care is on page 14. So on page 14, the dark blue line is the primary dealer's net holding of coupons. So this is duration. So again, they've been buying a lot of the duration that's been issued by the Treasury and the Fed. The primary dealers have been doing repo and just been holding on their balance sheet. And because the primary dealers, like they're a non-economic agent, right? Like they buy this, they'll do repo, they'll hope to sell it later. But what that's done is it's compressed the term premium. And the term premium, although it's not well understood and a lot of people make fun of it, the term premium is something that's very important for volatility, for market volatility across different assets. And so as the primary dealers have held more coupons, the term premium has actually become more negative, right? We're sitting at I think in this chart, it's maybe like 29 basis points negative. So just very quickly, what the term premium is it's the extra yield that you, as an investor in treasuries, should demand to hold longer dated treasuries, right? So why would I buy a
Right.
10-year bond if I could just buy a 2-year bond and then roll that 2-year bond on,
Every 2 years.
like four extra times, right? Um, so because if I buy a 10-year bond, I'm exposed to uncertain growth and inflation. You need to give me an extra premium to hold the longer dated treasuries. Well, right now, that term premium is actually negative. So the market participants, the primary dealers, are saying, actually, we will take less of a return to hold duration than to roll over shorter term securities. So that really shouldn't happen. But one of the impacts of that is it's been suppressing volatility in other assets. So if you go to page, let's say 15, this shows you, so the important line here is just that red line, which is the term premium. Every time over the last 5 years where the term premium has drifted positive or headed towards zero from the bottom, it's led to market volatility. We saw it early 2023, 2022, 2021, right? Because as the term premium increases, the yield on 10-year treasuries, for example, will increase, and then that starts to put pressure on other assets. If you don't believe me, I actually outlined the assets here, kind of on a cross asset approach, starting on page 16. So on page 16, as the term premium increases, again, as my uncertainty about the path of growth and inflation increase, because that's what the term premium is, well, bond volatility increases, right? Bond prices start to rise because, oh, maybe 10-year treasuries at 430 aren't really a deal if inflation's increasing, right? So you start to get more volatility in treasuries. Well, treasuries are the global safe asset, right? So if you get
Yeah.
more volatility in treasuries, that volatility tends to percolate to other assets. So on page 19, you'll start to see it percolate to other pockets of fixed income. So this is the MOVE index, which is Treasury vol, and I'm comparing it here to mortgage-backed security volatility. So mortgage-backed securities, they're an important part of the plumbing in the U.S. financial system. Um, you know, if you hold mortgage-backed securities, you need to hedge using interest rate derivatives. Well, if bonds are more volatile than interest rate derivatives, their prices start to go up. It becomes more expensive to hedge. You see something similar if you go to page 20 in terms of the equity market. So on page 20, you'll see the relationship between the MOVE index, again, bond vol and equity vol, which is the VIX. You'll notice that equity volatility has been suppressed over the last couple of years, despite the increase in the MOVE index or bond volatility. That's because most of the increase in bond volatility has been bond prices going up. Or put another way, a lot of the volatility in the MOVE index has been bond yields falling. So falling bond yields combined with the increasing bank reserves have been bullish for risk assets. It's suppressed volatility. So if you had a situation where the term premium's drifting positive, where you're taking liquidity out of the financial system because bank reserves, the money market funds don't have any cash to buy any more T-bills, and the primary dealers can't buy any more duration. Well, this will combine to drive more equity market fall. Now, on page 21 and 22, I get into the exact details of how QE impacts stock prices, right? And so it's not simple like QE means higher stock prices, right? Anyone who says that's not
Right.
being truthful. But if you look at all of the academic literature, and so I'll just give you the names so your listeners and viewers will can kind of look at this on their own. Ben Bernanke, who was a former Fed governor, he wrote about this in 2004, so well before QE, and then also in 2011. You've had Jonathan Wright who is at the Brookings Institution. You've had Alan Blinder at MIT. You've had Fed researchers, so Raskin and Gagnon in 2011. So all of the academic literature, what they find is there's two major ways in which QE supports stocks. The first way is when central banks are doing quantitative easing, it puts a floor under earnings expectations. So the market thinks, okay, the Fed's doing QE. The worst is behind us. Earnings expectations rise. So as earnings expectations rise, multiple rise, so PE multiples rise. That means the equity risk premia, so the yield on equities versus bonds collapses, and then the equity risk premia total return goes to the moon. So that's kind of what you see here. So basically, if bank reserves facilitate the carry trade, so that will support equities, and then you have and the way that works is basically Fed's doing QE. Great. The worst is behind us. Earnings are going to
Right.
improve. Fantastic. We can start
Right.
bidding up stocks again. The other way you actually see very clearly on page 22. Well, there's also a signal like duration comes out, but page 22, it's maybe my favorite chart in the deck. What this shows is the performance of low vol equities. These are like your stable cigarette companies, utilities, things that they're not sexy, but they provide a lot of cash flow, right? And so we have their relative performance versus the equal weight S&P 500. The light blue line has an exotic name. It's called the Wu Zhao shadow rate. But all that really is it's named after two Fed researchers from the Atlanta Fed. And all they try to do is say, if the Fed has rates at zero and they're doing QE, what does that QE mean in terms of like interest rates? So you can see in 2021, the Fed had rates at zero and it was buying $120 billion a month of treasuries. So rates felt like negative 2%. So if rates feel like negative 2%, don't give me low vol. I don't want cigarette companies, right? Give me long duration tech. Give me unprofitable tech. Give me dog coins. Those are the things that are going to go to the moon. And so now we're back in a world where the Fed's balance sheet's expanding again, liquidity conditions are expanding again. So as far as the market's concerned, interest rates don't feel like 5%. They'll feel substantially more loose because this liquidity has been injected back into the system. And so
Right.
really this comes down to one important thing. If the if the deficit's not going away, then liquidity is going to dry up. And the only way that the Fed can make sure liquidity doesn't dry up is to start expanding its balance sheet once again. And Powell's talked about this in December press conference, in the December minutes, and again, it's been brought up multiple times since then. And so if you have fiscal deficits mixed with QE, I think that's going to be an inflationary backdrop for the next few years. So QE itself doesn't create inflation. That's why we didn't have inflation, in the post GFC period. But fiscal deficits are inflationary. And if the Fed needs to expand their balance sheet once again to provide liquidity because of these fiscal deficits, then that's also going to be inflationary. And so if you go to page 27, the last chart I'll kind of leave you with is it means that the dollar will weaken. Now, dollar weaker versus what? Well, the dollar might not weaken versus the yen or the Canadian dollar or the euro because kind of all governments and all central banks, we're all kind of doing the same thing. But I think the dollar will weaken versus financial assets and versus hard assets. So on page 27, what I show here is the S&P 500 in gold terms and in dollar terms. And so the takeaway from this chart is that the stock price appreciation we've seen isn't so much stocks going up in price, it's the dollar losing its value, right?
Right.
Because you can see the spread versus gold as well. And so this is the outlook I have essentially for the next few years, unless something changes on the fiscal side where they just stop running massive deficits. But if they don't, you're going to have dollar down versus uh, you know hard assets like gold and other commodities, and then also financial assets do well. And so this is like if inflation just stays at like 2, 3, 4%. If inflation's at like 18%, which is not what I'm saying, then stocks probably would not do well. But if we're just in this, let's inflate away the debt at 3, 4% a year, then stocks do well because earnings are in nominal terms, and then hard assets do well.
All right. Well, we're running a little bit low on time, but I really want to just ask you quickly, just expand on this because you're referencing the dollar, but here you specifically in the chart title say fiat. The thing is
Mhm.
that I get the idea that fiat is going down. The question is how do you size it up in terms of the U.S. dollar relative to the other cross currencies? Because you see an incredible weakness in the yen and the euro and all these other currencies. How do you size that up in terms of the U.S. dollar relative to the other currencies?
Sure. So I think versus other currencies, what's going to matter is relative interest rate differentials. And so that's where I think the dollar comes out ahead. And, we've seen that in Japan where they've taken rates from negative and they basically put them at zero or slightly positive. But if if Japanese interest rates are 0 or 10 basis points and they're, 5% in the US, then the yen isn't going to strengthen. And if you have the same conditions in Europe where the European economy is weak and the ECB's interest rates are lower than the Fed, and the ECB actually looks like it's going to start cutting rates sooner than the Fed, then that doesn't suggest a stronger euro either. So it just really does seem that from a fiat perspective, I hate to use that term because it's overused, but the dollar is kind of the cleanest dirty shirt.
Right.
And so you won't necessarily see the weak dollar conditions versus the yen or the euro or even the CAD, but you may see it versus, like some other, maybe like the Swiss franc, for example. Though interest rates there are lower, but it's more like it's backed by something.
Yeah.
The Swiss they don't like to, like the Swiss francs generally backed by something. It's a hard money central bank. Um, but yeah, it's just the dollar probably does well versus most other currencies, but it just doesn't do well versus financial and hard asset or real asset.
Now, the last question I have for you is obviously I get this concept that that you're getting to over a several year time horizon, but there's this little pocket of time in here where generally these equities have been running, liquidity's been being provided, and even the Fed is inevitably signaling that they're going to transition to easing.
Yeah.
At some point, there's room for short-term market volatility. How do you size up the short term risks versus that longer term outlook?
Sure. So I think on the rate side, so my view is rates are going to stay higher for longer and QE is going to come back sooner. And so on the rate side, I think Jerome Powell's actually done a fantastic job of he's kind of been like the Pied Piper, right? He's been playing away on his flute and then the market's kind of dancing to his tune. And what I mean by that is we've had a hot labor market. We have hotter inflation, which I think is going to be a feature here. And rather than taking rate cuts out of the market, Powell's been able to convince the market to just price them further back. So don't take them out. The cuts will still happen. They'll just happen later and later, right? And so the market slowly gets used to that higher rate environment. I think where the risks really lie for risk assets is what happens when these liquidity conditions can't be supported by the money market funds or by the primary dealers anymore because there's no more money left on the reverse repo facility, or because the primary dealers are finding repo rates are just too high. And so that really comes down to the age old question of, will the Fed be proactive and start expanding its balance sheet before any liquidity drains become apparent? Or does the Fed do what it typically does, which is wait for something to break before saying, oh crap, we got to come in and
Right.
fix this. So I think like that's the real risk here is that reverse repo facility. It's being drawn down every day. We have tax payments that are going to be made April 15th, which will take liquidity out of the system as well. So you could get an issue there. But the Fed's going to have to do something because the deficit's not going away. So they're going to have to find someone to finance that.
All right. Well, Aidan, it was great having an update from you. Always love chatting with you, buddy. For our listeners that want to know more about you, why don't you tell us a little bit about PGM Global and where people can find you?
Sure. So we are we're a brokerage firm based in Montreal. We do three things, servicing all three service institutional clients. We have an agency only best execution trading desk. So we trade global equities, ETFs, and some developed market fixed income, all for institutional investors. We have a transition management business for institutional investors who may not manage directly, but will hire external managers to do that. And then we have the product that I've been lucky enough to run for the last 6 years and to work at for the last going on 9, which is the global macro strategy product. And so what we try to do is we're not trying to forecast GDP or inflation. What we're trying to do is figure out, look, what are the major drivers of risk asset prices globally and what's happening to those drivers, and then helping our institutional clients kind of position themselves cross asset across global market.
And where can they find you if they're interested in more?
Sure. I don't really post on Twitter all that much, although you can just search for me there. But if you are an institutional investor and you would like some more information about what we do, my email is here on the cover page. It's agarrib at pgmglobal.com, and I encourage institutional investors to reach out.
Fantastic, Aidan. No, thank you so much, buddy, for joining us. Looking forward to having you back in the future.
My pleasure. Thanks a lot, Patrick.
Well, thank you for tuning into. No problem. Thank you for tuning into the Market Huddle Plus. We'll be back next week with another episode. Cheers, everyone.